back to the channel. We are looking at the FOMC minutes, right? This is the Fed's expectations. Have they changed their expectations from the last meeting, or are they the same? Some of the questions that we're going to go through are, or that we're going to look for. Some of the questions we're going to look for before this meeting, we're going to look at CNBC, are what is the criteria for raising rates if they decide to raise rates in December, which I really doubt they do. Things look, pretty straight right now. How long is higher for longer? Has that changed? I think this is going to be the biggest change here. Is has the higher for longer changed? Previously, higher for longer was no rate cuts until 2025, right? Not till the end of 2024. Now that inflation is coming down faster than expected, we got core PC at 2.5% on a 3-month annual basis. It's possible that they actually do cut rates in May, somewhere in March. That's what the market is starting to price in right now. And last, are we looking at a soft or hard landing? So we're going to go through those as the FOMC minutes come out. Just so you know, FYI, we will look at the technicals. I think we have about 5 more minutes before they come out, and we'll talk a little bit about what's going on. And for the most part, I think that the Fed's going to be pretty dovish here. I don't think the Fed's going to get any more hawkish. I'll put that on as soon as it comes on. So yeah, and that's the deal, right? The market right now is now pricing in rate cuts in May. So we had them before. That's why you see that is one catalyst for the market going higher, right? Stocks in general, right? Crypto is a little different. You got the Binance news today, which is more certainty for crypto. Crypto is probably going to pull back and make a new move higher. But for now, what we want to focus on is when these minutes come out, what does the dollar do? What do rates do, right? What did the bond market do? The bond market sets the cost of capital for the market, not the Fed. That is for banks. So the bond market's going to set that, and then the dollar is going to scream or is going to reflect risk on or risk off going forward. So higher for longer. How much higher is that? Have they pulled back their expectations for that? What is the criteria for actually raising rates? I doubt oil's down, so there's not much to look at. And then later on today, we will look at NVIDIA earnings. We're going to do another stream, a separate stream for NVIDIA earnings. We'll take a look at Tesla, the news for Tesla, a lot of good news at Tesla later on. But today is FOMC. Today is the Fed. This is going to solidify, as we've been saying, this will solidify the soft landing and inflation expectations falling, right? Inflation expectations are falling. And before we hit that, let's take a little look at markets. How are markets trading at the moment? We will first take a look at rates, right? 10-year rates. So this is important. We're going to look here at, actually, let's just go through it, right? So first and foremost, look at the dollar. The dollar's sitting here at 103. Okay, the dollar, actually, let me change this up. I'm going to put myself down here for this meeting, or for these FOMC minutes, so that we can see what they're saying. All right, how's the volume? How you guys doing today? Hope everything's going well. Hey, we're in a bull market, right? And the dollar really gives us a lot of that signal. The dollar's been moving up. This was the bear market. Secularly, in general, weakness in the dollar signals strength in capital markets. Literally, when dollars sell off, when dollar comes down, they're being invested somewhere. So the way you can think about it is when people stack dollars, right? When there's more dollars into the system, more demand than supply, the dollar goes up. When that demand comes down, that's because the supply of dollars are being converted somewhere else. They're being converted in markets to some degree somewhere, and you see that correlation with stocks. So the dollar is now peaked and it's rolling over, right? We had talked about this in the past, and that is very bullish, or at least a reflection of strong demand for other assets. What to expect now? Can you expect what to expect if the dollar gets stronger? If the dollar does get stronger after this meeting, you remember there's always an initial reaction from the market, and then as it digests, that digestion will probably take place into Friday. I still think NVIDIA earnings are going to be more important than the FOMC minutes, but maybe if there's any surprises in the FOMC minutes, that could really change the market. But you need a big surprise. I think everybody expects the Fed to stay pretty dovish at the moment. So if the dollar does strengthen, then what you want to see is it strengthening because of rates, or on its own, or outside of rates. I think that for the most part, the dollar strengthening can come from two ways. Either it's tightening financial conditions, risk off, which the only way you get the dollar up on a risk off move is if there's some type of some type of risk off event, right? Some type of black swan event. But if the dollar also could move up, keep this in mind, right? This is literacy, market cycle literacy. The dollar could also move up if other central banks are printing faster. They debase their currencies, whether it's China, Japan, Europe, they can debase their currencies faster. And what happens is the dollar gains dominance because they're debasing their currency, right? They're lowering the value of their currencies versus the dollar. The dollar is valued versus other currencies. That's going to still be bullish for risk assets for the market because it's not a risk off event. It's just more of currency debasement in other currencies, right? But if we do get rates up, which I think I'm really going to focus here on the rates, right? 10-year rates, these have been falling. I think they're done. Rates peaked. We said rates have been, you look at rates peaked when Bill Ackman, the big billionaire, actually said, I'm done shorting the bond market. That's when they peaked. So after that peak, we've been coming lower, and that's going to fuel the bull market. So two important factors here for the macro forces. When the dollar rolls over, that is bullish for markets, right? That is a reflection of capital being invested into markets. When rates come down in this environment, right, usually it signals slower growth. We are receiving slower growth, but it's bullish for markets in general, for riskier assets, for the, very premium stocks, because this is the cost of capital for borrowing, right? If borrowing comes down, that is literally more liquidity into the system. So we'll keep our eye on that, right? But going over to the S&P 500, what are we seeing here? Let's go intraday. I think we have we got like 1 minute before the FOMC minutes come out. I'm going to pause it and then we'll go there. They come out at, 2 p.m. Eastern time. So yeah, we need Donald Trump, bro. We need Donald Trump. Yeah. I mean, we'll see what happens. I think more than that, you probably do need some better fiscal, but you need inflation down. The biggest issue here for markets to move higher is inflation, and it's been making progress. So we're moving higher, right? It is controversial. Lushanko is very controversial with politics. Okay, here's the FOMC minutes. We're going to go ahead and cut this out. Let me rewind this. Here we go. We're going to dive into it here, the FOMC minutes. Let me know if that audio is working. All right, let's get that. It's going to be a little delayed. All right, here we go. Let's listen into what they have to say. Give me a thumbs up if the audio is working. I appreciate it if you guys give me a thumbs up.
See the S&P 500 off just a little bit. Let's go to Steve Leisman now, the Fed News.
Minutes to the Federal Reserve's last meeting show that the committee believed that further tightening would be appropriate if progress towards inflation was insufficient. It's a bit of a more dovish take on the reasons why the Fed might hike again. All judged it critical for policy to be kept, quote, sufficiently restrictive and remain restrictive for some time. The committee was seen in a position to proceed carefully, so no big hurry on the part of the committee to do anything, because policy was seen as restrictive already and was seen putting downward pressure on the economy and downward pressure on inflation. Financial conditions, they said, had tightened significantly. And in the meeting, the officials debated the reasons for the rise in yields, the persistence of how long it would stick around, and the potential impact on monetary policy. You've heard that debate about higher yields doing the work for the Fed. This was part of the debate they had at the Federal Reserve meeting. Further evidence was required, however, that inflation was on a path to a 2% target, and there was only limited progress, they said, in bringing down core services inflation, though they thought they had seen much better inflation results in the goods sector. The risks to the outlook, they said, were more two-sided, including demand and supply remaining out of balance, persisting geopolitical risks, as well as oil markets being among the risks they discussed. Supply and demand, however, we're seeing coming into better balance. Inflation, they said, had moderated but remained unacceptably high, was the word they used. The labor market remained tight, but they saw wages moderating, and there was concern they remain too high at the moment for the Fed to be on target to this 2% target. Several said there was more upside to the consumer. Maybe they had more resources than originally thought. I'll leave it there, guys, except for that one phrase at the beginning that I mentioned, further tightening would be appropriate if progress towards inflation is insufficient. Seems to put the onus on the need to hike again, needing more data to hike again, rather than the bias to hike again and being proved why they shouldn't do that.
Indeed.
Tyler?
All right, thank you very much. Steve Leisman.
Okay, very dovish response there. We can, I don't know if they have anything else. I'm going to let it run a little bit on on pause. I mean that was the statement. Basically what the Fed is saying now that we look this over. Let's go ahead and turn to markets and we'll take a look at how the market is reacting to this. It looks like in general, look at S&P, right? Back above VWAP. So S&P is responding pretty well. You see that hammer candle. Let's take this off. That hammer candle is a reflection of positivity initially, right? We don't know what's going to happen. But the Fed is saying, hey, we actually need more evidence to hike. We're not going to hike. We're not going to hike. We're not going to hike. We need evidence to hike. We're more likely to stay here and pause. We're already restrictive. And one thing to keep in mind is, as a lot of people think that the Fed needs to hike to get inflation lower, like to put pressure on the labor market, to put pressure on inflation. But the fact of the matter is, the rate hikes work their way into the system as they are. They're already restrictive, and the further that inflation falls, the more restrictive the rate hikes actually become. Misnomer, or something that people that kind of fail to understand, is that they fail to understand that when inflation falls, that actually makes it more restrictive, right? The hikes are actually, or the rates are actually still very restrictive. So they're putting pressure on the market by just existing at that certain level. Okay, how does the bond market respond here? First, we'll go to TLT. Is there bond demand? Yes, we can see that intraday. Look at after the FOMC minutes, after the dovishness, we see that there's no way they're hiking again. They need extra evidence. What that evidence is going to be, they said it's going to be oil. If oil, I think I put it on here, oil markets. They're focused on oil markets. We know consumption is falling, right? Third quarter GDP was pretty high. Now it's coming down. We know that inflation in general, when it comes to energy, is actually falling. It's all dependent on oil prices. Natural gas is not going any higher. And oil is tame, right? Oil is tame. That is the golden goose here for the bulls, which is, as long as oil, all you got to do is look at oil. If oil spikes or gets out of hand, you might, and here's oil at the moment, you might get the Fed think about hiking again. I really doubt they do hike again. But oil in general, if we go to the daily chart, right, it significantly came off the highs. This is oil. This was the spike back in the Russian-Ukraine war. You can see we're significantly lower. We're making lower highs. So this was the big boom. Now here's the big run up where everybody got crazy. But what was the result of that? Was the U.S. is consuming less oil, right? U.S. consuming less, and we're increasing our supply at a record level. So oil goes lower, right? Less demand, more supply, oil goes lower. And now at the moment, oil is down from the highs about 21%, okay? 21%. So what does that mean? If you convert the energy inflation from oil over to CPI, well, it's going to come in much lower because oil is much lower. So energy markets are the only concern for the Fed. That is not even a concern. Next, the Global Supply Chain Pressures Index, which I don't really talk about on this channel too much, but it's basically the supply chain, health of the supply chains globally. That pressure is down significantly to record lows. And that means that there is more supply, there's more production happening in the world. So inflation is not coming back in any meaningful way. That's just not happening, right? That is just not happening. I know a lot of people say, oh, inflation is elevated. It is elevated, but it's not re-accelerating. And that's what the market wants to see. And we see the S&P. This is the Qs. I think it's going to be important more and more so to look at the Qs, because the Magnificent Seven are leading the market. Why? Because, I mean, they do generate the most earnings, and they have the best profit margins for the entire market. So you're going to have to look at those. How are small caps faring? Not as great, right? Today, anyways, because small caps are going to struggle here. Dow's, whatever. Anyways, going back to it, the bond market's catching a bid. This literally reflects interest rates coming back down, right? The bond market coming back down. What do I mean by the bond market? You go to the US 10-year. It doesn't look great, but the US 10-year, or the cost of capital, is on the daily chart, right? If you look a little back, let's take a step back here. On the daily chart, it's easing, right? So rates are easing, guys. You got to pay attention to this. The Fed funds rate is the 24-hour rate for banks, but the bond market, right? 10-year, 3-year, 5-year, 20-year rates, 30-year mortgage rates, those are starting to ease. You can see that right here. We got up to 5%, and we are now down, right, from this explosive move. We're now down from 5% to 4.3%. So the pressure is being released, and that pressure is allowing risk assets, including the Qs, to explode, which is why we do see, the Qs, or NASDAQ technology, making new highs. So somebody asked about NASDAQ. You can see we're breaking. Let me erase this. We are making new highs in NASDAQ. We said, hey, we're gonna have a Santa Claus rally. Here's the previous high. We're above the previous high. We're trying to support it as we speak. So if we go intraday, let's take a look at where that support is. We're literally at the previous high. This is the previous high for you NASDAQ 100s. I'm looking at the Qs as a proxy, but we need to get above this. This is the previous high. This was also the opening support turned into resistance, turned into resistance. So it's still resistance. So we need this to digest, right? We need this to digest. But overall, the FOMC minutes are bullish. I'm sorry, they're very dovish. The FOMC minutes are dovish. The Fed needs evidence to actually hike. They're done. We've said this. Inflation is done. So far, inflation is over. The acceleration of inflation is done. The Fed is done. I mean, hey, this is a great setup. So a lot of fund managers are going to pile in here. We'll go to Q&A if you guys have questions. Hassan, what did you say? NVIDIA report could boost the market or cause it drop 5 to 10% each direction. Yeah, it could. But keep in mind here too, NVIDIA, the demand for AI is only accelerating. You guys are seeing all the drama from Microsoft, from OpenAI. There is so much demand for these chips because simply the next backbone to markets, kind of like the internet, is going to be AI, right? Generative AI across the board is going to increase productivity, which grows GDP. And there's a lot of demand for those chips. So I don't expect NVIDIA earnings to be, soft at all. There could be a pullback right after the earnings, and then we bottom out Friday or Thursday. But for the most part, I don't see a 5 to 10% correction because the biggest issue is inflation and the Fed hiking, and it's over. The Fed is done. This is really the biggest bull case here. Abdul, what about the US 30? US 30. Is the US 30 the Dow? What is is the US 30 the Dow? Let's see. What is the yeah, it's the Dow. I'll just look at the Dow Jones. So this is what you mean, the US 30. This is more industrial stocks. So I mean, it's doing pretty well. If you look at the US 30, let's look at the bigger chart here. I'll put this on the daily chart. The US 30 is the Dow Industrial Average. Another name for that is just basically value stocks. You could call them value stocks, although the market is starting to change. All right, so here we go. This is the Dow, right? The Dow is at resistance. Here's your clear resistance. It's probably going to look different on the US 30, but it's the same chart. It's pretty much the same chart. Let's move this up. Here's the short-term resistance for the Dow. So yeah, markets are at resistance. And look, there should be a pullback at some point because we're a little overbought, right? We're a little overbought. So there will be a pullback, but we've been consolidating at the highs, which also means if we do consolidate at the highs, then we're digesting all the strength and we can move higher, just kind of like this move, right? So you come up, you accumulate, you stay at the highs, you move higher, you accumulate, you move higher. And we're also at a breakout point. We're at a breaking point here, and it's backed by the macro and it's backed by the fundamentals. What do I mean by that? Well, if we are at the highs, you want to pull back, but as long as the dollar decelerates, right, the dollar falls, and it should bounce too at some point. As long as the dollar falls, that's bullish for asset prices, right? That means dollars are being invested in general into the market. So they're going somewhere. And I think the Mag 7 is still leading, right? And then interest rates, again, have been the biggest catalyst for the markets. You go to the 30 years falling, 10 years falling. So as long as these rates fall, the Dow, NASDAQ are still going to break out. They're going to stay consolidating at the high levels. Gold, I think I see gold USD. We'll take a look at gold. I'm just going to look at this is the same chart. Okay. Gold USD, it's the same thing, right? Gold is basically a monetary asset, to make it clear. It's a monetary inflation asset. So gold is going to sniff out the end of the hiking cycle. It should move higher because gold appreciates when the Fed starts to turn, when more liquidity comes into the system, when rates come lower, gold will do better. A better proxy for gold. I know you guys don't trade Bitcoin. A lot of you guys don't trade Bitcoin, but gold and Bitcoin are going to do the same thing. They're going to react the same. The difference is Bitcoin is like an extremely hyper exponential asset or commodity versus gold. So gold's a $10 trillion market cap. It takes a lot for gold to move. It doesn't take much for Bitcoin to move. You got the ETF coming in January. So, or even earlier, it might come before January. So yeah, gold looks pretty good. If I were to do like some technicals on gold, you can see like you got a head and shoulders here. Here's your shoulder. This is the daily chart. here's your head, here's your shoulder. I just don't, I think it's going to be really hard to get gold to really move. But if you're just doing like Forex, then gold is setting up to break out above the previous high. What is this, 2018? About 2018, maybe 2020, somewhere around that, somewhere around here. So yeah, gold is moving up. It's going to strengthen because what are you looking at? Gold USD? Yeah. If the dollar keeps decelerating, gold's going to break out above that, maybe makes a move back to the highs. I just don't know how much room gold has to move. Carbides, what up? I prefer a pullback into good news. That's the perfect setup. I agree 100%. 100% if we go back to the S&P, or we'll look at Tesla. I know we were going to look at Tesla a little later when the NVIDIA earnings come out. So we'll just look at the overall market right now. But yeah, Carbides is completely right. Let's go to the 30-minute chart so we can kind of zoom in and see a little more details here, right? This was the wedge. We had that big gap up. We started to wedge. We broke out of the gap. So the perfect move for the S&P would actually be this trend continuation, right? You actually want to see that trend continuation for the S&P. This is just for the overall market. Again, I don't trade S&P because I would rather trade Tesla, but I think it would be nice, Carbides, if we did see a pullback, right? If we did get, we're seeing the good news. The FOMC minutes are positive. The FOMC minutes are bullish. They're I mean, dovish, which is bullish for the market. The Fed is done hiking, guys. That is the main catalyst here. It's not going to be a rip, an extreme rip higher, but the Fed is done hiking. They need more evidence to hike. What's the evidence? It's going to be oil markets exploding. That's just not the case. So let's see S&P maybe pull back into the trend, okay, and then just start trending higher, climbing this trend and go higher. See if we throw on those EMAs. It's okay. I'm not going to throw those EMAs on. So this is what Carbides is pointing out, which is it'd be better to see a sell-off into good news to shake out some of those weak hands and then move higher. So we're trending up, right? We are trending up. If we go to the Qs, you sort of see the same thing. You have that gap. I think the Qs are a little stronger. There's probably going to be less of a pattern on the Qs because there's a lot more FOMO happening in the Qs, right? There's a lot more FOMO happening here. But for the most part, the market's looking straight. What else we got here? Link at 1370, would you add? I've been adding on the way down. I've been adding little by little. I'm not adding a big portion, but I've been adding Asan on my Link position. I'm up to about 9,000 Link. I'm up big on Link, right? I'm converting all my Ethereum into Link. And let me tell you why. Watch, we'll go over this too. I know this was about FOMC, but we pretty much answered the FOMC minutes. The question for FOMC is, what are the odds of the Fed hiking rates again? Very low. They said they need more. How much is higher for longer? They didn't really answer that. And maybe there's something that we'll look into on breaking news on Twitter. But higher for longer, they didn't really say. There was no change there. Harder soft landing. We're looking at a soft landing here. We're looking at, and I know people say, hey, what about the banking crisis? What about all these, what about things breaking in the market? Remember the playbook, okay? This is why the S&P will continue higher. The playbook for the Fed, if something breaks, let's actually go back to the trading charts. If something breaks, the Fed steps in. We got a banking crisis in March of 2024, and the Fed's balance sheet went higher. There's shadow QE coming into the market. The Fed's balance sheet is not going up, but they are still injecting liquidity to the market. And the bank term funding program was a support system for the regional banks. That program has still been accelerating. So there's still liquidity to support the market. If something does break in real estate and it hits the regional banks, the Fed steps in again. That's why the market is appreciating higher. There's no recession in sight without a black swan event. You're welcome, Abdul. Binance CEO stepping down. Yep, Binance CEO stepping down. He's in trouble, and I think this is going to be good for crypto because it's certainty. Now we know. We just want to know what is what is actually happening. No surprises. So they owe about $4 billion. Who knows what happens there? Plead guilty for money laundering. Yep, exactly. So we're looking at the Q starting to appreciate. The dollar is weakening. Okay, so guys, after that report, if you're a Forex trader or just in general to understand the macro, a dovish Fed is a weaker dollar. Okay, a dovish Fed is a weaker dollar. Just keep that in mind. Dovish Fed, weaker dollar, right? Less pressure, weaker dollar. And then also that should mean A dovish Fed should also mean weaker rates. What are we getting? We're literally getting rates come down, right? This is the 10-year on the, what is this? The 3-minute, it's just only the 3-minute chart, but rates are easing and the dollar is easing. And, Bitcoin is starting to, I don't want to say it's pumping, but Bitcoin is appreciating a little bit. That means nothing right now. It has another catalyst there. So yeah, the dollar is weakening versus that. Now, I did want to show this too, like when it comes to the recession. I know a lot of people are like, oh my God, there's a huge recession. Here's why stocks are set to continue the recession. If you actually look at, this is a chart of earnings, S&P 500 companies citing recession over quarter over quarter over quarter over quarter. There's less and less of those citations of recession. So the stock market is not worried about, is definitely not worried about recession, right? That's why it's moving higher, because the recession already got priced in 2022. It gets priced in really quick. You need a black swan event. We're not seeing that. Credit standards are actually easing, not tightening. So this is the, this is the loan survey for credit standards for commercial real estate. And yes, commercial real estate is not doing great, but again, those are on the bank balance sheets. And if something breaks, the Fed steps in. Either way, conditions are not tightening. That would cause a surprise. Conditions are actually easing, right? The next big catalyst going forward for the Fed anyway is going to be core PCE. We just got done with the FOMC minutes, right? Dovish. What did we say yesterday? This is going to be bullish for the markets. Now we have core PCE coming in November 30th, right before December, and we expect that to be very low. As of now, the market is pricing cuts in May. We'll look that over again. So now we're looking at rate cuts sooner than expected, right? Shelter prices are so high. Rents are falling. This is rent growth in the U.S. Rent growth continues to soften, so that eases inflation to some degree. Household wealth is still, we're not going to look at that metric, but yeah, that is the backdrop here. We're seeing a lot of positivity going forward, and there's a lot of bonds. There's a lot of inflows into U.S. bond market, right? All right, let's see what else we got here. So yeah, that's the FOMC meeting. Let me see if there's anything else that they're saying here. Sufficiently restrictive. Oh, here we might have a little more. Let's. I think there's a little more talk here. We'll flip back to the. We'll flip back. Look, the dollar's easing though, right? The dollar's easing. We should see S&P start to appreciate here. We got some good news on Tesla, like I said earlier. But hey, it is gonna. Oh, I forgot to plug in my computer. It is gonna come down to Nvidia earnings. Now the market's like, okay, easy. We're gonna be easing here. No hawkishness from the Fed. Now we're looking at Nvidia earnings. I am keeping my eye here on Tesla. Tesla looks really good. Setting up for, look at that setup. That's a setup for a bull flag. This is a bull flag setup, right? You get a weakness on the open, sharp move away from price. Now you get the pattern forming. FOMC is done, dovish Fed. That's good for Tesla because interest rates are important. Tesla is no longer cutting prices. They're increasing prices in China. They're integrating into India. Exactly. There you go, Jervine. This is why I'm bullish. I got my full sizing on Tesla now. I got all my contracts. I'm swing trading Tesla. I'm looking a little further out. That's my style. It's not day trading. I want to capture a bigger move every once in a while. And yes, India closer to agreement with Tesla to import EVs and set up a plant. They're basically going to start production in India. They're going to start production in India. That's huge. And that's why the stock moved up versus the whole market earlier. More likely going to be 2024. And markets are forward looking too, so they're going to look forward. Also, BYD is letting go of some workers. Toyota is stopping their EV production. So the other EV companies, right, are not EV companies, the other OEMs, the other automotive companies, they're not successful creating EVs. They can't make a profit. So Tesla's going to take over at this point. It's going to be a very sharp landslide when it does come, because it's a lot of uncertainty. It's not clear. When the path clears up, I expect Tesla to run back to 300. And then if at full self-driving comes in, it's going to move to 400. It's going to make a big move. So here's the next resistance for Tesla. I think I have it, 260, somewhere around there. We'll see how it plays out. Actually, no, it's not 260. It's like 244. Either way, yeah. So let me get back to I think there's a little more. Let's hear what this guy has to say on CNBC about the minutes.
high frequency data. Does that count as an important data point?
No, I mean, they're so big, you have to pay attention. So, but the thing is, sometimes you get these high frequency moves that don't necessarily tell you anything about the trend. So if it's a couple of weeks that they're seeing weakness, that's one thing. If it lasts for a few months, that's something different.
Steve Leisman, your reactions, thoughts?
Well, there's a kind of curious line in here that maybe the consumer has more resources than they originally thought. There's another line in here that says,
Hey, just to that effect, the consumer has more resources than previously thought. Here is, I actually think I have that chart. It is right about, I know I have that chart somewhere. I thought I had it on here. It's basically the the disposable income. They found out that there's actually $1 trillion more of disposable income. And if you look at 2019, right, 2016 to 2019, there's a lot more income in households, right? A lot stronger income in households. So people are going to keep spending. Plus the baby boomers have a lot of cash here. I guess I didn't have that chart. I thought I had it. So there's a lot of disposable income. Yes, people are struggling, but it's not about a couple of people struggling. It's about the overall macro. Is there enough spending to keep us from recession? And that seems to be the case.
There's a couple Fed officials think that they may have more resources and there may be more upside consumer, and that if these upsides keep continuing, maybe there's momentum to it and it can keep going. The question is whether or not that's ultimately inflationary if the consumer keeps spending. I don't know. I see these minutes maybe a touch more dovish than Stephen does. Not the first time we've disagreed. I guess we agree more often than not. But I think the question to me, and this is the question I asked Powell, is at the press conference is, where's the bias? Is the bias to hike again, or is the bias not to hike? And these minutes, at least at that time, and Stephen's right that it's 3 weeks old, but I still think you've had financial conditions ultimately tighter than they had been, say, during the summer. So these minutes to me sound and seem a little bit more like the Fed has a bias not to hike here.
Yep.
Stephen?
I think they want to be done. I think that's, and
Yeah, they're done, guys. The Fed is done hiking. Where's the inflation going to come from? I would love to hear your thoughts and comments. Our Connect Through TV provider. I actually have, for CNBC, I got to say I have it for, I don't want to say it's free. I don't pay for it, but I do get it. I have a resource because I have a connection. I have a connection with somebody who's a contributor on CNBC. And so they gave me the resources. I think it's like $300 a month to get that. So I just try to use it for you guys to give you, not so you don't have to pay for stuff to see what's actually happening, right? But yeah, I get that. It's like $300 a month. That's way too much. That's crazy. But hey, it's here. It's here for free. Try to give you guys the best content I possibly can. Obviously, I really have. Oh, somebody mentioned Chainlink. That's what I wanted to get to with Chainlink. The best. I don't want to say the best crypto opportunity, but the best fundamental case in crypto outside of Bitcoin and Ethereum. Like this thing is very bullish. This thing is very, very bullish. And I think I just had some news on, I think this is pretty much over. Let's see if they have anybody else talking. I think they're just going over kind of how they're going to read into that. NVIDIA earnings are going to be the next big thing here. All right, let's answer some questions, and then I will pull up some stuff on Twitter that we just got. Here we go. The bull case. I want to talk about this. The bull case from Bank of America. They got S&P at 5,000 in S&P at 5,000 by the end of 2024. Very conservative as usual. Carbides. The markets were expecting the FOMC minutes to say something like, "We are done. Go buy the S&P." I believe that this report was extremely bullish compared to previous releases. The market is mute. Yeah, you know what? A lot of people say, "Oh, the market is so," or the Fed was so dovish, or they were so hawkish. Hawkish and dovish are, in my experience, are more relative to the previous meetings, not just one statement. Right? It's all about the previous meetings. It's almost like a stock trend. If stocks are at 4,000 and then they downtrend to 3,000 S&P, and then they go up for 3 days, yeah, that was bullish for 3 days, but not necessarily bullish because versus the previous trend, we're still in the downtrend. So what I'm saying here is the Fed's tone is becoming more bullish. It's been very hawkish, but now it's becoming more dovish bullish, right? The trend is changing. The trend of their tone has been changing lately. Now we're on pause, and now they're pretty much done. NVIDIA earnings might be the thing that keeping the markets neutral after this report. I just smell lots of bullishness over the, this doesn't mean make a trade on it, but I see a lot of bullishness coming in. Here's this report for, let's read this report really quick on Bank of America Global Research. Everybody's flipping bullish. I can't wait to hear from Mike Wilson. He's the big bear on the street, and Mike Wilson's he hasn't really been saying much. All right, so here's Bank of America's Global Research Equity Strategists, right? There's so many different people you have here. We forecast by the end of the year here. I don't know if that's not highlighted. We forecast 5,000 by end of the year 2024 for the S&P 500. That's 10% from today. The equity risk premium could fall further, especially out ex tech, which means excluding tech. We are past maximum macro uncertainty. Yes, we are, because inflation is done. The Fed is pretty much done. Oil prices are not. Oil's a big force. That's done. The dollar's rolling over. Rates have peaked. The market has absorbed significant geopolitical shocks already, and the good news is we're talking about the bad news. Macro signals are muddled, but idiosyncratic alpha increase this year. We're bullish not because we expect the Fed to cut, but because of what the Fed has accomplished. Yes, inflation is running lower. Companies have adapted. Look at this, is huge. Companies have adapted. This is why NVIDIA is going to raise, probably the earnings will set off a new bull market. Possibly. I mean, obviously it either goes up or down, but it's not very clear what's going to happen. Either way, the efficiencies is why the market's going up. Revenue fell, right? Revenue is decelerating at a slow pace, but profit margins are still rising. That means companies are being more efficient. They're adapting to the environment, and that's why stocks are so bullish, especially tech stocks. Higher rates, inflation, other reasons. And also big companies, they're taking these interest rates. We say this all the time. They're looking at the Fed funds rate at 5%, and they are literally parking cash. Like Apple has 160 billion on their balance sheet. They can park some cash in the money market funds and collect 5% interest and pay off their 3.5% debt. So to some degree, the Fed interest rates that are elevated, I know you guys always hear, oh, well, the rate hikes are going to play their way into the system. Yes, they're going to hurt weak companies, but other companies are actually creating more cash with the Fed funds rate elevated. They're creating more cash, right? So they're more bullish, and that's why you're going to see a dislocation with NASDAQ to the rest of the S&P or the Magnificent Seven, because they can leverage their cash to create a bigger position of cash, or to invest more, or to grow their earnings. And if they start buying back shares, that's even more bullish, right? Too many skunks at the garden party. Despite what feels like a big jump in sentiment recently, data still points to conviction, less equity bears, except for tech, AI. I love pension equity ways are 25 years. Let me see. I don't want to say or read all this language. Let's just see what they're saying. Long-term earnings growth for S&P 500. Basically, there's still a lot of cash on the sideline. And there was a chart that showed people were actually, retail was selling a lot of their tech. Let me see if I have that chart. Retail was dumping a lot. I don't think I saved it on here. Retail was dumping stock while hedge funds were actually buying stock. So, because they're getting scared by the recession fears, right? And it's just not playing out. Unfortunately, like, it's just easy to scare people. But the markets are still grinding up. So anyways, bottom up. Bank of America analyst survey reads Goldilocks. Just if you ever see this word Goldilocks, that means growth is accelerating while inflation is decelerating. That is the golden pocket for stock markets, for markets in general. It's all about growth and inflation. If you have inflation decelerating, which is exactly what we get, while growth is starting to lift. Now, growth is not growing at a fast pace, but it is better than expected. And if you have profit margins gaining while inflation's coming down, well, that's a very bullish outlook. That is called Goldilocks. A survey of Bank of America analysts in 2024 reveals broad expectations for decelerating but not declining prices. So this is disinflation, right? Disinflation. People think that means prices are falling. No, it means they're not rising as fast. So disinflation, but not declining. You don't really want declining prices yet. You do as a consumer, but declining prices also mean less revenue for stocks, right? Higher margins. Decelerate, so you get decelerating, you get disinflation, you get higher profit margins. Wage inflation are offset by wage inflation is kind of sticky, but it's not accelerating. It's just kind of sticky. Efficiency gains, more productivity gains, falling costs everywhere else. Producer prices we saw were literally negative month over month. Bank of America analyst tone, AI sentiment, research, blah, 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 blah. Growth positive. So just very bullish. EPS accelerates even if GDP slows. So even if you get GDP falling, right? They're saying even if GDP falls, you're still going to get growth moving up simply because profit margins, right? They're able to retain their earnings. They're cutting cost on things. So let's say you're producing some type of service or some type of good. Well, it costs you less to produce it. Therefore, you can retain those earnings and still grow your earnings per share for the shareholders. And that's very bullish. And if you buy back stock, that makes your earnings per share go up even more. You're paying back your shareholders. Now, this chart is why I'm so bullish on stocks, right? Global liquidity, I'll pull that up in real time. Global liquidity is turning up. Okay, this is basically how much money is coming back into the overall global picture. Yes, the U.S. is slowing, but if you look at the whole global outlook for central banks, there's more liquidity coming into the system, especially to support China, Japan, and the rate hikes are done. So the Fed is on pause, no more rate hikes. Global liquidity is turning up, and you see crypto starting to really take off now. So that is the bull case for crypto. In general, I think crypto is going to outperform everything. I say it all the time. It never really comes into play until you actually see the charts. See what else comments we have before we go over this. Nvidia earnings. Let me see. Somebody did ask about Chainlink though. So I'm keeping my eye on Chainlink for a very specific reason. And I'm going to go over this thesis right now. Right, it has a long way to go. So check this out. I'll be back too. I'm going to do another stream for, oh my goodness, more news. We'll go over that later. All right, so here's the thing about Chainlink. Okay, this is your price action. Look at that big, long consolidation, right? That's a big consolidation. Back to the highs is about 52. I think it goes to 150 this cycle. 150 easy with the macro cycle, right? Easy if the macro cycle continues, we go to 150. If we get a better cycle, if the Fed cuts rates and inflation comes down and growth starts to pick up again, and you get the Fed balance sheet coming back into play, man, if the Fed balance sheet comes back into play, I think it's very, it's not out of the ballpark to see Chainlink go to about 200, 240. So, oh my God, that's crazy, right? Well, here's what's happening with these markets, right? Tokenization of real world assets, right? This is basically taking equities, bonds, real estate, art, currency, every type of asset you can think of, and putting it on a system, a blockchain, where it can trade 24/7, 365, right? Just like Bitcoin and Ethereum trade 24/7, you're now going to have more liquidity, more opportunity 24/7. Okay, not only that, you get instant settlement. So on these transactions, there will be instant settlement. That's tokenization. You get instant settlement, 24-hour trading, much lower transaction fees. Okay, much lower. That creates more income, more liquidity also. And you increase liquidity in general because now you can connect to other blockchains. You have a lot of liquidity from other countries because the tokenization allows for less friction, okay? And then you increase the security at the same time. So the largest financial players don't want a fully decentralized world, which is why Chainlink is so important, because Chainlink does better despite crypto. It does better just with blockchain technology because it's linking them all together, Chainlink. And they want a hybrid system, right? They want to be able to plug in. Now, here's the big kicker. The total addressable market for tokenization is 16 trillion. It is 16 trillion. The gold market is what? 10 trillion? So Bitcoin is going to swallow gold. Chainlink is going to swallow tokenization. That's a $16 trillion market. That doesn't mean Chainlink is going to be 16 trillion. It just means if it takes a percentage of that, we're looking at a $200, $300 Chainlink, looking forward, right? Forward estimates, especially if rates are coming down, yields are coming down. So that's part of the bull case for Chainlink going forward. And yeah, I just wanted to point that out. What are we at? 45 minutes. Let me double check the the Twitter. I think something came out for FOMC. We will finish off on that. Make sure we didn't miss anything. For the minutes, could be something we missed. There's always something you could miss. Let's go to real time. Let's go to the Qs. I'm gonna start looking at the Qs here. Obviously, because the Qs are going to lead, the S&P. So we're tagging along here on VWAP, right? To get more, I don't want to say to get more bullish, but this is our resistance right here. What is this? 388. We got to hold 388. 388.50. Okay, 388.50. That's what it is. So you get all this supply, or supply. I just call it resistance. There's so many names for it. People get all butthurt. Oh my God, it's called the supply zone, bro. It's resistance. Okay, this is your resistance. 388.50. We're gonna wait for NVIDIA earnings. I think that's all there is to it. Probably trade sideways. All right, let's see if there's anything new here. FOMC minutes. Fed rate expectations little changed after the Fed minutes. First rate cut likely in May 2024. Fully priced in for June. Wow. Yep. So right now the market is pricing in a cut in May, January, February, March, April, May. So 5 months in is the next rate cut. That's why we're going to all-time highs for the Qs for sure. S&P, I think it looks like we're going to hit for all-time highs also by the end of the year. They're not going to hike anymore. See if there's anything else. Blah, 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 blah. Fed minutes, participation note. I think we went through most of it. Yeah, I mean that's all there is to it. So it's NVIDIA earnings. Let's take a look at NVIDIA, see how it's trading right now. Is it selling off? Nope. Man, there's just a lot of demand. You see that sharp sell off and it just bounced right back above VWAP. There's probably a lot of insider information here. There's probably a lot of insider information for NVIDIA. It just doesn't stop. It's probably not going to stop because the AI boom. NVIDIA is the structural force that supplies artificial intelligence, right? By providing chips, silicon chips, the very advanced chips. So there's just a lot of demand for this company. Also, you guys got to keep in mind here, we talked about this I think last Monday before the market really ripped. A lot of managers, fund managers or institutions, they're playing catch up. They're trying, it's called window dressing, where in order to show performance, they just start buying big tech mega caps, right? Magnificent Seven. They start buying them to at least show their customers, whatever you want to call them, that, hey, we did own NVIDIA, we did own Apple, we did own Tesla, we did own, AMD, we did own Apple, Amazon, whatever it is. So they're starting to chase, right? This is the year-end rally. They're going to start chasing, and that's just going to make the S&P go higher, and then it causes more chase. Chase begets more chase. Liquidity, what? That's running right now? Liquidity? Oh, yeah, I forgot about liquidity too. Liquidity is a big factor. So if we go here, right, let me take the Bitcoin off. The Bitcoin, where's it at? Oh, okay, I see. So this is Bitcoin, but for the most part, global liquidity is here in orange, right? And you can see that global liquidity is starting to pick up. I think it bottomed out. I'm pretty sure it bottomed out at this point. And typically when liquidity goes up, crypto goes much higher. Liquidity goes up, crypto goes much higher. So does NASDAQ. I mean, this is all tech. This is all risk assets, high beta. High beta goes up. And, you don't want to get stuck in the non-quality assets, but these are assets that are very quality. So you're starting to see this happen, right? You can even chart it. But once that liquidity runs up, right, once it starts to really start making a move, then it's game over. If you want to look at it on a year-over-year basis, right, this is part of I don't want to say my thesis. I like to follow Raoul Pal, if you're familiar with him. This is global liquidity on a year-over-year basis from the 4 major central banks. So the biggest institutions in the world who increase money supply, that money supply on a year-over-year basis is climbing again. So liquidity is coming into the system, and capital markets love liquidity. They love liquidity. So that's the backdrop here. Let's go ahead and wrap it up. The Fed is done. Okay, the Fed is done. Inflation is done. So far, inflation is over. The Fed is done. The markets are a little overbought, but they're going to either consolidate or pull back and then move higher. On top of that, your biggest risk is oil spiking. Doesn't look like it's going to happen for inflation to reaccelerate. Your other risk is that you have an economic collapse. From where? From what? The consumer falls off a cliff. Well, guess what? They have $1 trillion of savings, excess savings. They have jobs, right? The labor participation rate is up. It's growing. It's pretty tamed. I mean, not tamed. It's pretty strong. So people have jobs. They're going to keep spending. They're going to slow their spending from season to season. I expect January and February to slow down. And if there is any real risk to the economy, well, we're headed into an election year. What do politicians do? They print money. They hand out checks. If there's any type of weakness, the market will sniff out those checks beforehand and actually price that in by moving much higher. Is that going to re-accelerate inflation? No, because the supply chain pressures index, supply chains are very strong. This is not 2020. This is not where global supply chains are down. We got strong supply chains getting stronger. AI is lending to productivity and efficiencies. Therefore, any type of inflationary pressures can be absorbed by the strengthening of the supply chains, by stronger production. Therefore, we're actually setting up for a very explosive rally into 2024. I don't think we see a big, long recession. I just don't see it, right? Initial claims, if you guys want to see the unemployment rate, focus on initial claims, right? Focus on the 4-week average of unemployment claims. Those claims have not made new highs. They are climbing, but they climb and they roll over. They're not making significant highs. So stay tuned. If you're new here, we do macro, we do technicals, we look at the fundamentals of the market, try to give you everything. The bread and the butter is going to be the macro and the technicals. On top of that, I'll be back again so stay tuned, hit your notification, like, subscribe. You guys stay blessed. I'll be back for NVIDIA earnings. Let's go. All right, I'm out of here. You guys stay blessed.